I've asked Nathan to come and speak about the Morningstar portfolios, and in particular given what's recently been happening geopolitically and the impacts. But Morningstar's had a very good year, and as you're probably aware, Morningstar figures in the majority of our portfolios in our client base. But without any further ado, Nathan, I'll introduce you, and we can raise questions as we go. Thank you.
Thanks, Murray. Appreciate that. I will briefly share my screen with you. Just confirming you can see my screen?
Absolutely.
Wonderful. Excellent. Well, look, I guess to your point, Murray, it has been volatility is probably the one thing that's been very constant in the markets, and globally equities definitely did react to some of the earlier noise in the year from Sir Donald Trump with his US tariffs in that particular landscape. So we'll talk a little bit about that as well. Let's just move along. The all-important disclaimer, everything is general by nature, and we haven't taken anybody's personal goals or objectives into consideration. Now today, look, whilst we have a conversation, we'll discuss some asset class performance, what we are seeing in the global equity valuations and opportunity space. We will focus a little bit on some of the Morningstar portfolio, and there'll be a little bit around what we're doing responding to some of the changes or some of the things that we are seeing in the market. Firstly, asset class performance. Look, you rightly pointed out, Murray, that asset classes have been quite buoyant. And I think that a lot of investors over the last number of years, it's been to some degree a bit of a purple patch in reality. When you look at the information here in front of us, and we can see that Australian shares and global shares on the whole over the last 1 year, 3 year and 5 year, they've really generated some very strong returns for investors. We also do know that over the longer period of time, circa about over the last 100 years, the asset class returns are a little more modest than what we have been seeing. So I think it might be prudent just for investors to look at things, and what we are doing at Morningstar is to some degree taking some profits in some of those positions that have been running very, very hard and performing very, very well this year and over the last year or so, because we think that that is prudent practice to making sure that we don't want to risk investors' money, and where we feel relevant, we will definitely look to take some profits from some of those asset classes.
I think to your point there, Nathan, it's true, because generally over rolling 20-year periods, the expectation has been about a 10% return for US equities, Australian shares, Australian equities. But as you can see there from your slide, we've had outstanding returns, and if you look at the 5-year returns, they're well and truly above the long-term average, aren't they?
They are. No, absolutely. And look, whilst you don't look a gift horse in the mouth, so to speak, I think it's definitely, you need to be prudent as to where the current valuations are sitting across the markets, most definitely. With regards to global equity valuations, look, as you can see, on the whole, valuations are probably starting to be somewhat fully priced in to some degree across some of the markets there. We do feel as though there are other markets globally that are providing a little bit better valuation or an opportunity to investors. Conversely, as you can sort of see there, comparing where the US market or the domestic market currently sits compared to the tech bubble and also the global financial crisis, they're at some lofty valuations, I guess you could say.
And it's interesting when you see the developed markets and the emerging markets where they sit, given longer term performance. Obviously, opportunities there from a Morningstar perspective.
Look, absolutely. Yes, no, emerging markets has been an area that a lot of our portfolios have had some exposure to over the last couple of years, and we've been, throughout the journey of this year so far, taking those profits from some of those pointed areas. China is one of those particular areas in the emerging markets, and especially the likes of Alibaba or Tencent, for instance. And with that overweight exposure that we tend to have throughout the portfolios, we've been trimming some of those exposures because some of those companies have done stellar returns just this year, north of 60% in some cases.
Yeah, and you've had exposure to China over the last 3 years, even when it was out of fashion, didn't you?
Look, absolutely we have it. And that's to the philosophy of Morningstar. When there is a sector or a geographical region that seems to be strong negative sentiment, we will tend to look a little bit more closely at that particular market, because we know that we only need the sentiment to turn from horrible to bad to make investors some good money. We don't necessarily need to wait for the broader market to catch up with our thesis in that sense. I know that we've discussed it a little bit, yourself, Murray, and I, around the concentration risk that we do see out there in the broader marketplace. And this slide here effectively shows us the equity breakdown or the regional exposure of the MSCI ACWI broader global equities benchmark. And what you can see here, that over time, the allocation or the amount of that broader index that the United States makes up has gone from about 40% through to now sitting at 65%. So that brings a lot of concentration risk for those more passive index orientated exposures that investors can have sometimes. And as we also know of the US, the top 10 companies of the US, those large mega cap IT stocks, they make up a very significant proportion. So for investors that do have a strong exposure to passive nature, there can be that significant concentration risk. And I think some investors might have experienced that when markets did fall a little earlier this year in April on the back of concerns around Trump's tariff announcements.
Yeah, so interesting, the amount of, if you're just investing in the index, how much exposure you'd have to one economy.
Agree. What this slide here is, this talks to our global experts, so our capital markets forecast team. On an ongoing basis, they monitor over 400 asset and sub-asset classes globally. And then what we look to do is, on a rotational quarterly basis, consolidate that down into a nice, more palatable number of opportunities that you can see there on the slide. And essentially what this slide tells us is that the opportunities we find for investors based on our proprietary models and our data research tells us that on the left-hand side, we'd prefer to be invested in some of those geographical regions or sectors that are shown here on the left. Conversely, on the right-hand side, there's some of those regions or sectors that we'd prefer to have an underweight. By all means, we need to take common sense into account in this particular landscape. But as a real-life example, Australian financials, we know that they've had a good run over the last 12, 18 months. We do feel, especially from a Commonwealth Bank perspective, valuations are starting to be a little bit towards the top there. And therefore, as a result, we feel as though that the risk is more on the downside to the investor than it is on the upside. Whereas conversely, over on the left-hand side, there's some of those markets that we still feel as though that when we think looking forward over the next 5 to 10 years, there's some asset classes or some regions that we do feel will provide better returns for investors compared to those asset classes or sectors on the right. Healthcare is definitely one theme that we've been more excited about of late, and the introduction of AI into that industry is very much at its infancy. I think a lot of your clients would probably be aware of what we have been seeing with the AI themes running through the markets over the last couple of years. Now we're starting to look for those secondary industries where we know AI will be able to generate strong efficiencies, reduce down costs, therefore increase revenues looking forward. So that's now some of those industries that we've been starting to do some thesis on.
Right. Okay. And how do you go about actually readjusting these portfolios, Nathan? It's done very subtly, isn't it, in the marketplace?
Look, it is. Some of the underlying building blocks that we have inside of our portfolios makes it very efficient and makes it very effectively. There are two fundamental building blocks in our portfolios: the Morningstar Multi-Asset Real Return Fund and the Morningstar Global Opportunities Fund. Now, those underlying building blocks give the portfolio managers the ability to take a position, rebalance portfolios in a very strategic way, rather than also having to rebalance all of the underlying assets, whether it be the listed securities or whether it be the ETF, so to speak. And by being able to do so, we can do it in a very timely manner. An example of that was back in April, when Donald Trump did announce those tariffs. The market did fall quite quickly in a very short period of time. So the investments team were able to go into the market Tuesday morning local time here, and were able to buy some instruments to asset classes such as the US S&P 500 market, and then be able to massage that throughout the portfolio. So it's a very timely, efficient and cost-effective way for them to be able to run the portfolio. Look, my last slide here that I've really got is this just gives there's a lot of colours here, granted, bit of a patchwork quilt style, and it effectively just talks to the sector and region exposure within the underlying portfolios as at the end of August, so to speak. So what you can see here is that for a growth 70-30 risk profile, this is the equity exposure in front of you here. And you can see of the total 70% allocation in equities, about 21.5% is in the Australian market. And this slide here, if you put this next to that valuation of implied return slide that we were talking about, those opportunities we look at, we tend to see a higher green allocation to some of those where we feel as though there is a better propensity for investors looking forward, and a more of a red exposure to some of those that we feel as though we'd prefer to take a bit more of an underweight, so to speak.
I think what's interesting about this is that, on a weighting basis, the US economy, as you mentioned in a previous slide, is up to 64% of the world economy. But in terms of your active management approach, you've only weighted 23.45% towards North America.
Exactly.
And the Australian economy, you weighted 21.48%, which obviously we only compose less than 2% of the world economy. So is this testimony to the active approach that you guys engineer?
It definitely is. On the whole, you can see that we still have a preference for international equities over Australian equities. Yep. And by and large, the diversification and the opportunity set of global equities is what leans us in for our preference in that sense. But when we do talk about international equities, as you rightly pointed, that doesn't necessarily always have to mean a large proportion to North America. You can see here we've got a good exposure to the UK, Japan, Europe, and also emerging markets as well. So by all means, yes, that's where we can start to broaden out our asset class exposure across the geographical regions.
And in terms of the actual sectors that you're allocating to at this point in time, it would seem that consumer discretionary remains quite high alongside financials and healthcare.
Financials have been starting to bring back they were a little bit higher initially. The regional banks, especially in the US, we pointed into them a couple of years ago. I don't know whether you can remember, but the Silicon Valley Bank issues that were occurring there. We had this feeling that there are a lot of good quality assets there regionally throughout the United States that were also being punished with what was occurring within Silicon Valley Bank. So we have trimmed some of our financials exposure more broadly there. But to your point, absolutely, consumer discretionary, there tends to be a very strong link between what happens in the consumer discretionary space and what happens with the Chinese consumer. We know the middle class consumer within China has got a lot more money than the traditional middle class here in Australia. They have been a little bit slower coming out of that COVID negative sentiment than what we like, but we have been starting to see some good green shoots from the Chinese government starting to bring out some more fiscal policy to help stimulate the economy in that sense. So there's definitely some good consumer discretionary, think luxury brands, think some of that UK, European automotive industries as well, that we have been tucking into our portfolios over the last 6, 9, 12 months.
And real estate seems to be making an appearance again as well. It's been some time, hasn't it?
It has been. Look, having a strong correlation to what we see in the rates markets, it's very rate sensitive, that particular asset class, whether it be residential, commercial or industrial in that particular sense. So look, we have been increasing slightly our exposure to that asset class over the last 12 months, give or take, but it's very slowly, given that some of the data that we're seeing in some of the economic environment, we still have some hesitations in not wanting to push the button too quickly, I would suggest, in that particular asset class.
Yes, yeah. And how you manage money and manage these asset classes, I know it's a valuation approach, but also I guess you're looking thematically at where different sectors and even economies are going, aren't you?
Look, without a doubt, we don't want to. Our chief investment officer, Matt Wacher, always says that it's a bit of a mug's game trying to predict the markets. And I think that between economists and weathermen, they're the only two people who can hold their jobs, make their predictions one day, get it wrong and still get to go to work the following day.
Yeah.
But in saying that, we definitely do. So our team will look thematically across a number of different asset classes on an ongoing basis. And whilst we use valuation as that somewhat of an anchor, so to speak, we'll look at both relative and absolute return profiles. We'll then start to take into account some of that risks and the sentiments that are maybe available with those particular asset classes or sectors or regions, such as geopolitical risk that you touched on a little bit earlier. And then we'll also start to look at what maybe some of those broader economic risks might be for certain sectors and companies as well.
Well, that's excellent. Well, Nathan, thanks for your time this afternoon. Much appreciated. And I'm sure our clients will welcome this very short expose, as it were, into Morningstar's current asset exposure. Thank you.
Thanks, Murray. Appreciate your time.
Any advice in this video is general advice prepared by Morningstar without reference to your objectives, financial situation, or needs. You should consider the advice in light of these matters and any relevant product disclosure statement before making any decision to invest.